Let's take a look at what's happening in the markets. As you already know, we've had somewhat of a brutal reversal at this 200-day moving average, which is kind of what we were looking for, right? Because the last time we were reviewing markets, we said this was going to be a difficult area to move past. And sure enough, stocks went right up to that line and turned around. Now, a lot of this movement has been blamed on what the Fed came out and said. Now, did what the Fed say actually move the markets lower, or were they going to move lower already? That's the question, right? But mostly what happens is that price drives narrative. So the price does what it's going to do, and then we all attribute it to what happened in the news. So Powell, he came out and unsurprisingly reiterated his intent to aggressively fight inflation. So this is from the Wall Street Journal with highlights from us. While the central bank's steps to slow the rate of investment, spending, and hiring will bring down inflation, they will also bring some pain to households and businesses. This is what Powell was saying in his speech. Those are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. We're moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. While the Fed's current rate setting is in a neutral zone that economists expect would neither speed nor slow growth when economic growth is well balanced, such a level of rates is not a place to stop or pause when inflation is so high and the labor market is so tight. Mr. Powell cited projections officials made in June in which most thought they would need to raise rates to slightly below 4% through the end of next year, which appeared to push back against some investors' recent expectations that the Fed would pivot more rapidly to cutting rates next year. Powell said we will keep at it until we are confident the job is done. So once again, with price driving narrative, because we had this nice rebound in the market, all of a sudden the news flow started saying that, hey, we think the Fed has reached peak hawkishness and they're probably going to cut next year, which doesn't make much sense. It's just another great example of the peanut gallery applying a story to explain a market move after it happens. In reality, the market ran up over the past month because more people bought than sold. And more people bought than sold because there were fewer left to sell as positioning and sentiment had run too far too fast. And we said that in this move lower, right? That it was way too skewed into bearishness, which means we would probably get this type of rebound. It's all about sentiment and positioning in the market, right? When people are overly bearish and they sold everything, there's only one thing left for them to do, which is buy. And that's the rebound we got. So even though we got this rally, guess what? We're not done with inflation, and the Fed is going to keep tightening until they could rein it in. So this volatility in the market, it's not over either. So our base case for the path of the markets as of now is a strong sell-off this week, followed by a bottom and a hard reversal that leads to another leg up. Now, of course, this environment is fast moving and there's a lot of variables at play, so our conviction is low. But you can see right here how we plotted the move in the charts. We could get a rebound all the way back up to highs, but then head lower again because we are in this more sideways volatile regime. But overall, the large secular trend is still very much intact. And this correction looks like the many others we've experienced over the last decade. So you can kind of see that long-term trend in the Russell right here. Last year, you could see we overshot this trend line and now we're correcting from it. And every time you overshoot a trend line like this, and maybe this is easier to see, you can see it overshoot this white line right here, you get the opposite happen where we could undershoot this white line. But if you look at the total trend, you'll see we're still going up. So the market recently saw a number of breadth thrusts fire. And breadth thrusts are when a number of stocks move higher together, which is exactly what you want to see in a healthy market. And those are solid points for the bulls. They mark instances of large buying pressure, and these types of demand imbalances are what drive large trends. So these breadth thrusts mean buying support over the near term, but longer term, a continuation of the correction is likely. So the two graphs below show every time over the past 25 years that the percent of stocks above their 50-day moving average crossed 90%. So there have been 147 instances total, and 125 of those were higher 3 months later. Only 17 were in the red. So the average gain was 6.65% and the loss was around 5. That's another positive stat for the bulls. So those breadth thrusts, along with the number of others that fired last month, are important signals. But they need to be looked at in context, and the biggest killer of any further market rally here is yields. So if bonds fail to catch a strong enough bid, meaning that yields would go down because that's what happens when bond prices go up, if they don't catch that bid on the back of this market weakness, then we could expect an acceleration in this risk-off move, meaning more selling in stocks. As of now, bonds have not offered much of a countervailing force to the risk off in stocks. So that's a good reason to be cautious if you're bullish here. So we've talked about this in the past. Bonds have not been working properly to counterbalance the stock market. You can see here, as I'm recording this midday Monday, bond prices are down along with the rest of the market. What we would want to see is the market down and bond prices up. We saw that the last 2 days, not so much today. And if you look at all these other rate indicators, bonds have really not been doing their job. The Conference Board Leading Economic Index recently hit 0% on a year-over-year basis. Now, if it continues to fall, which we think it will, then stocks will be in their lowest returning environment per the LEI. And that's where average annualized market returns are negative 11.2%. Our current state is where we're above zero and rising, but we're tipping over into these two, where the returns get really bad. Our recession indicator that uses 17 various econ, financial, and market inputs to assess the probability of a recession, it currently assigns a 100% probability of a recession within the next 2 years, and a 30% probability of one within the next 12 months. So yeah, it looks like that recession is still coming, and it fits in line with what we were saying before, that it's coming at the latter half of 2023. Citi's bear market checklist now has 8 sell signals within the US and 6 for the world out of 18 total. When half the number of these signals say sell, and when they're red, that's when a cyclical bear market typically follows. One of the reasons why we called in position for a summer rally back in July was because sentiment positioning were maxed out bearish, and we talked about that. It's difficult for the market to remain at negative extremes for too long, especially when financial conditions remain as loose as they are. So while our trend fragility index has risen from extremes, it's still quite depressed. And this, along with the chart that we're about to talk about in a second, are largely why we believe stocks will surprise everyone to the upside over the next few months before turning over again. See, it's hard for stocks to fall too far too fast without a significant tightening of financial conditions, which we haven't seen yet. And right now, financial conditions in general remain quite loose. They're tightening broadly, of course, and that should continue to accelerate as the Fed raises rates and the economy slows. But if you look at where they are today relative to past market tops, it's a different story entirely. So in this type of loose financial environment, it's going to be tough for stocks to just fall. So as you just seen, we got a lot of different data points on both sides. This is why things change really fast in this market and why it's a pretty dangerous market. So make sure your risk control is in place. We are definitely not out of the woods yet. And if you haven't already, make sure you check out this video right here about why social media stocks are finished. We have a real interesting discussion about what's going on in that space now. So click here and I will see you in that video.